Okay, so let's talk about something that, on the surface, might sound a little dry: inventory accounting. But I want you to stick with me because what we're really diving into is one of the sharpest strategic tools in any manager's kit. We're about to see how a simple accounting choice isn't just about counting stuff, it's about actively shaping your company's financial story. So let's get into it. I want to kick things off with a big question for you. How is it possible that a simple accounting choice can totally change your company's reported profit? I mean, really think about that. This isn't some trick question. It's a fundamental reality of business, and the answer shows you just how powerful accounting is as an active management tool, not just some passive, boring record-keeping task. So here's where the problem starts. Let's say you run a coffee shop. On Monday, you buy a batch of beans for $10 a pound. Then on Wednesday, prices go up, and you have to buy another batch for $12 a pound. Come Friday, you sell 1 pound of coffee for 20 bucks. So what was your cost for that sale? We call this the cost of goods sold, or COGS for short. Was it $10 or was it 12? Because how you answer that question changes your profit on that sale from $10 all the way down to 8. See the problem? Well, one of the most common answers to that puzzle is a method called FIFO. It stands for first in, first out. And you know what? The logic behind it is actually beautifully simple. It just assumes that the first items you bought, your first in, are the very first items you sell, the first out. So going back to our coffee shop, FIFO says your cost of goods sold for that Friday sale was $10, the cost of that first, older batch of beans. Let's make this crystal clear. Think about milk in a grocery store. The staff always pushes the older cartons to the front, right? So they sell first before they expire. That's FIFO in the real world. Now, in accounting, we're just applying that same exact logic to the costs. So when you make a sale, you assign the cost of those Monday goods to it, no matter which physical bag of beans the customer actually walked out with. First cost in, first cost out. Simple as that. Okay, so we've got the what. It's a simple, logical rule. But the why this matters so much to you as a manager, that's where things get really interesting. It all comes to life when we see the effect this has on your numbers, especially in what we call an inflationary environment, where the cost of everything, like our coffee beans, just keeps going up. This is the moment accounting stops being about rules and starts being all about strategy. All right, let's break down what happens here. When prices are rising, your oldest inventory, our $10 beans, is also your cheapest. With FIFO, you're matching those cheaper costs against your revenue. The result? A lower cost of goods sold, which means you report a higher gross profit. Your income statement suddenly looks fantastic. At the same time, the inventory you still have is valued at that newer, higher $12 price, which gives investors a more realistic picture of what your assets are worth today. But, and this is a big but, here's the trade-off. Higher reported profit also means a higher tax liability. Yep, you look more profitable on paper, but you're also going to be writing a bigger check to the government. So how do you use this strategically? When is FIFO the smart play? Well, it's a total no-brainer for businesses with perishable goods. Think grocery stores, pharmacies, where you're physically trying to sell the oldest stuff first anyway. It's also a great choice for companies that want to show a really strong balance sheet to lenders or investors, since that inventory is valued at current, up-to-date prices. Basically, it's for any business whose strategy prioritizes showing higher current profitability and a more modern valuation of its assets. And that brings us to the most important takeaway here. Your choice of inventory method is not just some quiet back-office bookkeeping task. It is a critical, high-level strategic decision. It directly impacts your profits, your taxes, and the entire way your company is seen by the outside world. And that should leave you with one last thought. We've just peeled back the layers on a seemingly simple rule like FIFO and found all this strategic depth. It makes you wonder, doesn't it? What other simple accounting rules, things like how you handle depreciation or when you recognize revenue, are also hiding in plain sight as powerful management tools? The moment you start asking that question, you stop seeing accounting as a chore, and you start seeing it as a playbook. And trust me, that's a total game changer.